Welcome to the wildly anticipated second episode of the 4pm Fill. Your fill of the market this week. All in 10 or so very high quality minutes. Now, I'm joined, as always, by my brother, my partner in crime, and of course, the Associate Director of Savannah Asset Management, Sam. Welcome.
Thank you, Jack. They said we were crazy for starting a podcast. They said it would never work, but here we are, 10 subscribers later, with our second video. Looking forward to discussing a big week in the markets with you.
Indeed. Now, Sam, our audience knows the drill. Every week, we knock off with a beer of our choosing. So what are we looking at this week?
Well, Jack, today we've got a couple of Cooper's Pale Ales here. A beautiful crisp ale with just the right mix of fruitiness and bitterness.
Well, wait. So, let's do it, and do it well. Now, kicking it all off with Sam's rundown of the markets this week. Take it away, brother.
Well, Jack, it's been an eventful week on the markets. On Monday, President Trump announced a 25% tariff on steel and aluminium. Interestingly, the market reaction was fairly neutral, with US indices all finishing slightly higher, led by an average 3.5% jump in the metals sector. On Wednesday, however, markets fell after US inflation data recorded a 0.4% year-on-year change in January, above market expectations and marking the highest CPI increase in 1.5 years. However, as of this Friday, US markets have rallied following the release of January's producer price index, which was slightly better than expectations. Overall, the S&P 500 has gained 150 bips for the week, while the ASX is poised to finish up around 50 bips. However, the big winner for the week is the Euro Stoxx 50, which has shot up a further 3%, representing a whopping 12% gain for the year.
Yeah, now that is really interesting, Sam, because typically the European indices have lagged the US indices, for the last couple of decades?
That's right.
So what's been causing that sudden surge?
Well, it looks like it's a combination of factors, Jack. For one thing, Euro stocks are looking pretty cheap compared to their US counterparts. They are trading at a price-to-earnings ratio of 17 times versus 26 times in the US. Another reason is that European company earnings continue to be fairly robust. Just this week, industrial giant Siemens announced a positive quarterly result, triggering a 7% increase in the stock price. A weakening euro and positive developments in the Russia-Ukraine conflict have also provided a macroeconomic tailwind. All in all, a very good start to the year if you're invested in European stocks.
Thank you, Sam. Comprehensive analysis, as always. Now, it's headline of the week time. What's been clogging up space in the papers? Well, Sam, it is headlines galore, as always, in Donald Trump's America. What did you pick out this week?
You're right, Jack. This week we saw tariffs, inflation prints, further developments in Gaza and Ukraine. But I want to focus on something a little more salacious, what people are calling the battle of the billionaires. Earlier this week, Elon Musk threw a $97 billion bid at OpenAI's non-profit arm, hoping to take control and merge it with his own AI venture, XAI. However, in an interview with Bloomberg, Altman confirmed that OpenAI is not for sale and alleged that this was simply a tactic to distract OpenAI. Altman even went as far as to condescend Musk, saying he doesn't believe Musk is a happy person and, quote, his whole life is from a position of insecurity. I feel for the guy. Now, Musk retaliated, branding Altman a swindler and referring to him as Scam Altman.
Not bad. But of course, Sam Altman and OpenAI are part of Trump's $500 billion Stargate initiative, paid for mainly by SoftBank, OpenAI, and Oracle, and so not under the watchful eye of scrutiny by Musk's Department of Government Efficiency. Surely, given Musk's proximity to the Oval Office, this means there could be scope for Altman and Musk to be working together on the Stargate project.
Well, that doesn't appear to be the case, Jack. Trump appears to be keeping Musk on the outer on this one. And in fact, Musk has actually criticised the Stargate program, stating that it is already falling apart before it even starts.
So, Sam, what appears to be just a petty feud on the surface, despite the Stargate investment being a big win for the administration, this could presumably have pretty severe implications for America's AI future.
Jack, it has huge implications for the world's AI future. Right now, there is a global AI arms race where China, with DeepSeek, seem to have taken the lead. The last thing that the US needs right now is infighting at the top. But Jack, that's enough of that. Let's get on to your hot take. Right, time for everyone's favourite segment. It's Jack's Hot Take. Now, Jack, before we jump into your latest rant this week, I think it would be remiss of us not to check in on your last week's prediction. Let's run the clip back.
I'm looking at crude oil price, and specifically, I think that price is going to come down and way down. I deem Russian supply constraints as being a decent chance of easing in alignment with the conflict, showing positive signs of ending. All in all, a perfect storm for that oil price to come crumbling down, and in doing so, ease the cost of living pressures, not only for Americans, but globally.
Now, Jack, or should I call you Nostradamus? How on earth did you predict the positive progress in the Russia-Ukraine conflict this week?
Well, Sam, I think anyone who wants to get an edge on the markets should be dedicating time to carefully analysing Trump and his agenda. Now, as an avid Trump watcher myself, there were a couple of very telling signals that progress was just around the corner, not only from Trump's recent rhetoric and near pacifist agenda, but perhaps more pertinently, it was the murmurs from both Zelensky and Putin. Now, look, it's still early days there, but I must confess I was very satisfied when I saw that the oil price came tumbling down as predicted in alignment with the positive progress. And so, this week's take. Now, I was initially going to talk about how US small caps are seemingly more tariff-proof, given that they typically have far less multinational exposure. But I'm reliably informed that you'll be covering that territory in the coming minutes. So, now it's quirky, but today I want to talk about what I'm labelling the pro-Raytheon triangle, comprising three angles: Iron Domes, the Department of Government Efficiency, and the direction of the US military.
Here we go.
Yes, indeed. Samuel, who helped build Israel's famed Iron Dome?
Who, Jack?
Well, it was Raytheon. And Samuel, who is pushing very hard for their own Iron Dome style, sophisticated air defense system?
Well, Jack, I'm guessing you're going to say Trump and America.
Nailed it. And Samuel, Doge is looking at military spend with two things in mind: cutting wasteful spending and substantially boosting innovation, as well as prioritisation of US protection. So, one area where spending will not be restricted, which continues to be outlined as a priority, and also happens to be extremely innovative, would be this sophisticated air defence system. And Samuel, this is very much Raytheon's domain. It would be a bit of a shock if the overwhelming favourite, with a vast advantage in this area to tackle this project, wasn't selected. Now, for context, Israel is about the size of New Jersey, or more specifically about 0.22% the size of the US, and their estimated cost to date is somewhere in the vicinity of $3 billion. I would very conservatively estimate that a US air defence system would cost at least 20 times that of Israel's. That is a lot of money in the coffers of the company chosen, and that is the pro-Raytheon triangle, my friend. Now, who knows? In a few years, the US might just have their first $1 trillion market cap defence stock.
Who knows, Jack? Hot as always, we'll hold you to it.
Well, I will hold you to your next segment, Sam's Market Insights. Sam, what magic have you got in store for us this week?
Well, Jack, I thought I would continue on the theme of tariffs this week. Now, as you know, last week I went on the public record to say that Trump's tough talk on tariffs is largely a bluff. Now, despite further developments this week, that opinion has not changed. While Trump is whacking tariffs on steel and aluminium, these represent less than 2% of US imports, so it's not really going to move the dial. Additionally, I was interested by the comments of Trump's former advisor from his first administration, Stephen Moore, who said that Trump's agitating on tariffs was more about getting the world's attention, and that just about everything Trump does is a negotiation tactic. We also heard from Trump's former chief strategist turned convict, Steve Bannon, who exposed Trump's flood the zone strategy, the tactic of deliberately flooding the public discourse with initiatives to destabilize the opposition, regardless of whether those initiatives are real or illusionary. But bluff or not, Jack, we are seeing that the spectre of tariffs is weighing on public markets, with major US indices generally sliding over the past couple of weeks. So, how can investors navigate this? One approach might be to focus on specific industries that could benefit from a protectionist regime, although that may be hard to predict in advance. Another more easy strategy might be to simply rotate a portfolio toward companies with minimal exposure to foreign trade. This Morningstar table shows that among various segments and styles, small to mid-cap value stocks are the most insulated from foreign trade flows, with a 79 to 81% of their revenue coming from the domestic US economy. So, if you trade US equities and want to mitigate your exposure to a potential trade war, US SMIDs may be a good way to achieve that.
So Sam, presumably your portfolio at Savannah Asset Management has been impacted by the spectre of tariffs. Can you give us maybe an example of a company in your portfolio that has been affected, either positive or negative?
Well, Jack, one company that we are watching very closely is a company called Steel Partner Holdings. Now, despite the name, this is actually a conglomerate with operations spanning industrial, financial services, and energy, to name a few. This is a stock that has increased 10% over the past year and close to 300% over the past 5 years. And despite this growth, we still see really strong value in this company, including a price-to-earnings ratio of 4.3 times and a price-to-book ratio of 0.8 times. But Jack, the reason we have a close watch on this stock is because despite a down week in the market, the stock price of Steel Partners has had a nice little run in recent days, returning around 5%. Now, the company does not share detail around its dependency on foreign trade flows, but the recent share price movement is certainly an interesting signal that this is one stock that may be favourably positioned to benefit from a tariff regime. In any case, it's certainly one we will keep an eye on.
Well, that's riveting as always, Sam, and thank you for your insight. Now, that is a wrap for this week's 4pm Fill. It might be time to grab a schooner at the local. And of course, if you enjoyed this episode, then do the right thing. Subscribe. We'll be back next Friday junk time. See you then.
Cheers.
Cheers, guys. That was fun.
Well done, mate. That was good.